Finance and economics, while often used interchangeably, are distinct fields with unique focuses. Finance is the science of managing money, encompassing activities such as investing, borrowing, lending, budgeting, and saving. It deals with the allocation of resources and the management of risk and return in financial markets. Economics, on the other hand, is a broader discipline that studies how individuals, businesses, governments, and nations make choices about allocating resources to satisfy their needs and wants. It examines the production, distribution, and consumption of goods and services, and seeks to understand how economies function and interact. Understanding the distinction between finance and economics is crucial because it shapes how we approach and solve different problems. In essence, finance is often more concerned with the specifics of markets, investment strategies, and the financial health of companies or individuals. Economics provides a more overarching view, offering insights into how economies work, why markets behave a certain way, and what influences economic growth or recession. This fundamental distinction underscores their importance and relevance to individuals, businesses, and policymakers. One real-world application that highlights this distinction is the stock market. Finance professionals analyze financial statements, manage investment portfolios, and make decisions to maximize returns, whereas economists might study the impact of stock market trends on the overall economy, including consumer spending and employment. Another example is government policy. Economists may evaluate the effects of fiscal policy changes on inflation and employment, while finance experts focus on the implications of these changes for capital markets and investment. Despite the inherent differences, opinions often overlap in both fields. For instance, financial decisions can be informed by economic theories, and economic policies might be evaluated based on financial metrics. However, challenges arise when the two fields are conflated. This can lead to confusion in decision-making processes, as what is financially prudent may not always align with broader economic objectives. Moreover, the interdisciplinary nature can lead to controversies. For instance, when economic theories suggest outcomes that contradict financial market performance. Ultimately, finance and economics are intertwined, influencing and informing one another. Economics provides the theoretical foundation for understanding market behaviors and systemic risks, which finance uses to develop practical strategies for managing money. By recognizing their distinct purposes and applications, we can more effectively leverage insights from both fields to address complex financial and economic challenges. Finance is a discipline that focuses on the management, creation, and study of money, investments, and financial systems. It encompasses activities such as lending, borrowing, budgeting, investing, and forecasting. Core concepts of finance often include time value of money, risk and return, asset valuation, capital markets, and portfolio management. These concepts underpin the decision-making processes that determine how individuals, businesses, and governments allocate their financial resources. The distinction between finance and economics becomes apparent when we consider their core concepts. While economics is concerned with the production, distribution, and consumption of goods and services, finance is more specific to money management and the tools used to achieve economic objectives. The core concepts of finance are crucial for understanding its role as a distinct discipline that supports economic activity by optimizing financial performance and stability. In practice, the core concepts of finance are applied daily. For instance, the time value of money influences decisions such as whether to invest in a project now or wait for better opportunities. This concept is crucial for calculating present and future value, helping individuals and corporations evaluate the profitability of investments. Another application is in risk and return analysis, which guides investors in choosing a portfolio that balances potential gains with acceptable levels of risk. The concepts of finance ensure informed decision-making in the stock market, determining the valuation of shares, and advising on the right mix of investment assets. Supporters of these core concepts argue that they provide the framework necessary for sound financial planning and wealth accumulation. Financial theorists emphasize the importance of understanding these fundamentals to navigate complex financial environments confidently. However, some critics point out that these principles can sometimes oversimplify the unpredictable nature of financial markets. For instance, assumptions about market efficiency and rational investor behavior often face scrutiny during financial crises, when markets behave unpredictably. The core concepts of finance significantly influence other aspects of the overarching topic, particularly in how they interact with economic theories. Economic conditions shape financial markets, and in turn, financial decisions impact economic outcomes. Understanding finance's core concepts allows individuals and institutions to make decisions that align with economic trends and cycles, thus highlighting the interdependent yet distinct nature of finance and economics. This connection underscores the importance of distinguishing between the two fields, while appreciating their synergies in contributing to economic growth and stability. Fundamental principles of economics refer to the core concepts that form the foundation of economic theory and analysis. These principles include the ideas of scarcity, supply and demand, opportunity cost, and marginal analysis. Scarcity underlines the basic economic problem. Resources are limited, while human wants are infinite, forcing individuals and societies to make choices. The law of supply and demand explains how prices are determined in a market economy, highlighting the interplay between producers' willingness to sell and consumers' willingness to buy. Opportunity cost involves the idea that every choice has an associated cost, representing the next best alternative foregone when a decision is made. Marginal analysis involves examining the additional benefits and costs of a decision or a small change in the level of an activity. Understanding these principles is crucial when distinguishing economics from finance. While finance focuses on the management, creation, and study of money, investments, and financial instruments, economics provides the broader analytical framework for understanding market behavior and decision-making processes. Economics helps in comprehending the environment in which financial systems operate, thus offering insights into issues like inflation, interest rates, and economic growth that impact financial markets. Two real-world applications of economic principles include government policymaking and business strategy. For instance, governments often rely on economic data and theory to shape fiscal and monetary policies to manage economic performance. Concepts like aggregate demand and inflation inform decisions about taxation and interest rates. Similarly, businesses apply economic principles when making strategic decisions, such as pricing products or entering new markets, using supply and demand analysis to forecast potential sales and profitability. Some economists argue that a strong understanding of economic fundamentals can lead to more informed and effective financial planning, as these principles highlight the interconnectedness of various economic factors. However, there are challenges and alternative viewpoints. Some critics point out that economic theories often rely on assumptions that may not hold in real-world complexities, such as perfect competition or rational behavior. Moreover, the normative aspects of economics, which involve value judgments, can lead to controversies, especially in policymaking. The fundamental principles of economics are interconnected with finance, as they provide the analytical tools needed to understand economic conditions that affect financial decisions. By grasping these principles, one can better appreciate the complexities of financial markets and the broader economic context within which they operate, illustrating that while economics and finance are distinct fields, they are intrinsically linked. The interconnection between finance and economics is a pivotal concept in understanding their roles within the broader framework of commerce and policy. Finance typically focuses on the management of money, investments, and financial systems, while economics explores the production, distribution, and consumption of goods and services, along with the behavior of economic agents. The interconnection emerges because financial systems operate within the larger economic environment, influenced heavily by economic theories and policies. This relationship is crucial as it helps in interpreting financial phenomena in the context of broader economic dynamics. Recognizing this interconnection is significant as it underlines the dependency of financial practices and markets on economic principles and policies. For example, inflation rates, which are economic indicators, directly impact financial decisions, such as interest rates set by banks and investors' portfolio strategies. Similarly, the economic concept of supply and demand influences asset pricing in financial markets. Understanding these linkages equips policymakers and market participants with the tools to make informed decisions that align financial growth with economic stability. A real-world application of this interconnection is evident in monetary policy adjustments by central banks, such as the Federal Reserve in the United States. When the economy shows signs of inflation, the Fed might raise interest rates to cool down economic activity, directly affecting financial markets by making borrowing more expensive. Another example is the 2008 financial crisis, where the interconnectedness of finance and economics became starkly apparent. Economic policies aimed at deregulation allowed financial institutions to undertake risky behaviors, which eventually led to a global economic downturn, illustrating the profound impact economic policies can have on financial stability and vice versa. Opinions supporting this interconnection highlight the necessity for a balanced approach in policymaking, where economic insights are used to guide financial regulations. Critics often point to examples where misalignments have led to crises, suggesting that an integrated approach is critical for sustainable growth. Challenges to this concept include the potential for over-reliance on economic theories that may not always predict financial market behaviors accurately. Moreover, differing economic conditions across regions can make it challenging to apply universal financial strategies. This intricate relationship influences other aspects of the main topic by illustrating that while finance and economics are distinct disciplines, their interdependence requires a holistic approach in education, policy formulation, and strategic planning to ensure that financial practices support and enhance economic well-being. Understanding this interconnectedness is essential for anyone looking to grasp the complexities of global financial systems within the context of global economic trends.